U.S. economy in a very good place, performing well. We see signs of global growth bottoming out. We see reduced trade policy uncertainty. Overall, the background, we see strong job creation, continued moderate growth, all of those things. All of this happens in the context of a good, strong U.S. economy.
Fed Chairman Jerome Powell sharing his views on the U.S. economy. Let's get more insight now on Fed policy. Still with us is David Kudla, Mainstay Capital Management founder, CEO, and Chief Investment Strategist. Thank you so much for sticking around, David. So let's talk a little bit about Powell's testimony, because he seemed mostly positive about the U.S. economy. Does that give you more confidence on where the markets, the equity markets, could go from here?
Yeah, it does. You know, we had the 3 rate cuts last year, preemptive by the Fed. They called it a mid-cycle adjustment that seemed to be timed pretty well. And, you know, leading into 2020, before the coronavirus and what that means to the global economies, we really were, in the U.S., it looked like we were in a Goldilocks economy. We had reasonable growth, not very strong, but reasonable growth. Jobs still coming in quite good. The last 2 jobs reports were quite good. Reasonable GDP growth at around 2% for last year. And, you know, unemployment still near, our most recent read, still near 50-year lows. And the consumer is still pretty strong. So, you know, we're in a pretty good place, with the Fed remaining very accommodative, as I talked about in the last segment. So we're in a good place for the U.S. economy, and I think that was reflected in the statement. I agree with it.
So contrast that to what's happening in the international environment with the outbreak of the coronavirus, ongoing trade tensions. Then would you say that domestically focused small companies could be a better bet than those large companies with more businesses overseas?
Well, I don't think that. I think that the environment we're in right now, so 2 questions in there. So let's break that into 2 parts. The first part, you know, we saw at the end of the year that it looked like with PMIs around the world that the global economy was starting to recover. We were starting to see what looked like a rebound of the global economies, and the coronavirus may have interrupted that to some degree, and that's yet to be seen as to how severe that impact is on the global economy. In terms of where to invest, what we've seen and what we believe is the major catalyst for U.S. stocks, and really for most stocks around the world, is this central bank stimulus, these liquidity injections into the market. We're at a PE of 18.8 right now in the U.S., which is pretty rich by historical standards, and the market keeps marching ever higher. And I think that's a large result of liquidity being pumped into the market. Where's that liquidity go? Large cap growth stocks, the large liquid blue chip stocks. So we're avoiding, you know, even if they look attractive, some of these value stocks look attractive, small caps look attractive, but we're primarily focused on these large blue chip stocks. And if you look at where the action has been, if I can use that phrase, but if you look at where the action's been, year to date, 2/3 of the return in the S&P 500 is in 4 stocks. 4 stocks: Microsoft, Apple, Microsoft, Apple, Google, and Amazon make up 2/3 of the return of the S&P 500. So 4 mega cap stocks.
David, you know, if what you say is true, as with SARS, that demand isn't destroyed, it's just delayed, does that mean we're setting up for quite a stimulus-driven recovery at the other end of this? And in that case, do you buy any short-term correction?
Yeah, I think that there is an opportunity. You know, the human tragedy aside, you know, when we get to the other side of this, you know, I think this will be a lot. There's differences between the coronavirus and SARS, and there may be a little bit more demand destruction this time. You know, with SARS, there wasn't demand destruction. It was just demand delayed. And there might be a little bit more demand destruction this time, but it's still primarily going to be mostly demand that is delayed. And so on the other side of this, there will be some real opportunity. and that opportunity will be a tactical opportunity for investors. And that, with stimulus, could be a real opportunity for investors.
David, always appreciate your time, but we have to leave it there. David Kudla, Mainstay Capital Management founder, CEO, and CIO.